Warren Buffett, the goat of investing, has recently dropped more wisdom on all you fellow value investors out there in his 2 hours interview with CNBC. So in this video, I'll be reacting and just sharing some of my thought process because while he was speaking, I was actually taking notes on the sidelines. I'll share some of the insights that I've managed to elicit and also maybe some of my takeaways and my entire understanding of what he has to say. And of course, it's a two-way street. If you guys have any other learnings that you have gotten from this specific interview or maybe other parts of the interview, remember to help leave in the comment section down below as well. And as always, don't forget to smash that cute little like button like I did for CNBC. So with that, let's get right into the first clip where Buffett is essentially talking about raising his stakes in the Japanese trading house.
Why did this trip happen, and why did those investments happen to begin with?
Well, the investments began maybe close to 4 years ago, and I was looking at company after company, as I'll do every day, and I just thought these were big companies. They were companies that I generally understood what they did, somewhat similar to Berkshire in that they owned lots of different interests, and they were selling at what I thought was a ridiculous price, particularly the price compared to the interest rates prevailing at that time.
So there was two main factors or two main issues that Buffett pointed out. Firstly, he did say that he kind of understand what the business is doing, pretty similar with what Berkshire is doing as well. So they are huge conglomerates. They have investments or they have positions in many other industries as well. And the second part is about the idea of value, where he does think that they're trading at a very attractive valuation in accordance to the interest rate environment that they're operating in. So two important factors in air quotes value investing: circle of competence, hunting for value, which is not overpaying. So let's see what Buffett has to say.
So I started buying all five of the five largest trading companies, and by my 90th birthday, August 30th of 2000, whatever it was.
2020.
Yeah, we had bought just somewhat over 5% of each company, and we were buying identical amounts. So we announced at that time that we bought this 5% interest in each of the five. I wrote a letter to the CEOs of each of the companies saying the same thing, that we would never buy, Berkshire would never buy more than 9.9% without their consent. And that was my word. It was Berkshire Hathaway's word, and they all welcomed us in, and their results have exceeded our expectations since we purchased the group. I think their dividends on average have gone up 70% or something like that, and we now own 7.4% of each of the companies. And
if you didn't catch what Buffett has to say, he did say that the dividends for all five on average has gone up by 70%, 70. So I think when you look at Buffett's purchase in these different Japanese trading houses, honestly, he's just betting on value. So it's essentially a quote-unquote value pick. He don't know which one of them will outperform. He don't know the characteristics of probably maybe the different managers and stuff like that. But he does know that in this entire basket of equities, specifically in the Japanese market, there is probably value, or at least some of you might call it deep value. Because the idea behind these sort of equities is that a lot of people have been beating down Japanese equities. They have been experiencing a lost decade, or maybe lost 3 decades. I think for the last 30 years, the stock market has essentially not seen all-time high. And this is essentially the nature of value investing. It's controversial in nature. When everybody is not looking at some places, there might be value to be reaped. I'm not going to say that there is guarantee of value to be reaped, but especially when a place that is extremely overcrowded, for example, your US equities, I think value is hard to come by unless there is a huge event, a catastrophic event, maybe like the 2008 crisis or the 2020 COVID crisis. If not, If it's business as usual, interest rates remain low, and you have excitement in the stock market, I think it's pretty much very hard to find value or to extract value. You kind of have to head to places where other people are not finding things or finding for gems, and it's probably easier to kind of extract those value from there, and which is why this investment into these Japanese trading houses. So I know that some of you are business owners yourself, and being an accounting student, I appreciate how tedious and how tough accounting can be, and I want to tell you guys about Awesome. So they are the experts in organizing your business accounts so that you don't have to worry about filing company reports or even paying taxes on time. Awesome accountants take care of all your finance admin through the app and are always on hand to answer your questions and give advice based on your company accounts. So track your finances while managing your payments and invoices all in one place so that you can focus on the more important stuff like building your products and reaching new customers. So they will walk you through setting up with your new accountant in a few easy steps, and it's like having a finance manager but at an extremely lower cost. As a bonus, if you choose one of their sign up packages today, they will also help you incorporate your business for free. If you're interested in starting a business, you can click in the link in the description box down below to get 16% off your first year. Thank you Awesome for sponsoring this video. And on the second point about this idea of value investing, many people have the thought process saying that, oh, if no investors are there, if no smart money, hot money is flowing into the stocks itself or into that market itself, the classic example here is the Japanese market. If no money is flowing to the Japanese market, what is going to prop up valuations? Nobody's buying because the stock market is a demand supply, right? So there is the focus here by Buffett saying that especially if the underlying business, the fundamentals of the business is strong, if the cash flow remains strong, if the earnings remain strong, you don't always need to get back your returns in terms of stock price appreciation. So in this case, I do understand that after Buffett bought into the position, they kind of went up in value because of the Buffett effect. Everybody just follows Warren Buffett. I don't know why. They can just buy Berkshire Hathaway stock instead. But back to the point, even if the share price don't appreciate in this instance, especially if the fundamentals of the business is strong and you have good management team in place, they can return the accrual value to shareholders, whether is it via buybacks, via dividends, etc. And like Buffett said, the dividends has already increased by more than 70% over the last span of, 3-4 years. So in this case, value investing is, I guess, simple but not easy. You find a business that is operating rather effectively, you have good management team in place, make sure that the business has a competitive advantage that allows them to continue reaping supernormal profits, and ensure that good management team is in place so that the profits can be returned to shareholders. Who cares whether the stock price will appreciate or not? Somehow or another, capital and the accrued value will be returned to you as shareholders. I think this is generally my main takeaways around his bet on these Japanese trading houses. And who cares whether the Japanese stock market is experiencing 1, 2, or 3 lost decades? To him, he probably don't really care about them. Next up, moving on to the second video. I think the second video is around the idea of what you can control and what you cannot control. And it's essentially Buffett's comment on the Federal Reserve, which is Jerome Powell. And don't forget to smash the like button.
What do you think of the job the Fed is doing right now?
No, I do not think I could run the Fed as well as Jay Powell's run. I think Jay Powell has been a terrific, and part of the job, well, look at Paul Volcker back in the 1980s. I mean, people were sending him, he needed Secret Service protection and everything else. But in the end, he felt his responsibility was to do the right thing at the Fed, and he didn't give a damn about what anybody wrote about him or anything else. And I think that he's one of my heroes, and I think he's one of Jay Powell's heroes. And I think Jay Powell did the same thing actually in March of 2020 when we went into the pandemic. I think at the annual meeting that year, I said, that he was a hero and he is a hero, and you have to act, and you have to act on insufficient information, and you've got an ultimate responsibility to the American public. And it doesn't mean you can stop recessions. It doesn't mean that you can turn bad loans into good loans or anything else. But it does mean that you got to keep the system working. And the system came close to stopping. If you read a book called $1 Trillion Triage, you can get it on a day-by-day account. And people don't know how close it was. And Jay Powell did not call for studies or position papers and, lengthy debate and everything. You just don't do it. You act. And that's what Paul Volcker did. And I thank heavens, Jay Powell was there. I mean, you could have gotten a very different result in March of 2020 after the pandemic broke out.
Did the Fed keep rates low for too long after that?
Who knows? Who knows? We won't know. I don't know what they precisely should do, and nobody does. And they follow conventional wisdom and all of that, and sometimes it works out and sometimes it doesn't. But since 1942, we've made all kinds of mistakes in this country, and we'll continue to make them. But somehow the system works pretty damn well. I'd rather own stocks than bonds over many years. I'd rather own part of America than try to squirrel my money away some other place. I thought, maybe in Switzerland, Credit Suisse or something like that. It just people are they don't really get any wiser about this sort of thing. Somebody else fire, they're going to run for the door. I mean, it's built into. Fear is so easy to arouse in people. And you talk about fear about their money, and they don't really understand the system necessarily or anything of the sort. And they can actually, by their own actions, then create what they were afraid of. It's a very interesting phenomenon, and it actually. My dad hated Franklin D. Roosevelt, but so I grew up. First 10 years of my life, I couldn't get dinner unless I said something nasty about Roosevelt or something. But over the years, when Roosevelt said the only thing we have to fear is fear itself, he was 100% right. When he closed the banks and said, I'll open the good ones a week from then, he didn't know anything about which bank was good or bad or anything like that. But people just needed that, get an appropriate confidence. And now they've really got an appropriate confidence, because we didn't have an FDIC, and we didn't have an FDIC that was required for every bank.
So I think I really love Buffett's comment about whether Powell did a good job or bad job. The answer is pretty simple. It's called who knows. Honestly, of course, many of us on the sidelines are saying that, maybe they've pressed down interest rate a little bit too long, too low, too long, and now it's a little bit too little, too late. But I'd just like to say that who knows the correct answer? There is no correct answer. All these are based on hindsight bias. How we see things started playing out, and then we see that inflation is running hot, and then people start blaming, why did Jerome Powell not act quicker? Why did the Fed continue to be complacent, etc., etc. This is because of hindsight bias. For those of you who are commenting on the sidelines, saying that you guys had the foresight of God to know what to do next and whatnot, I would encourage you to be putting yourself up for the position of the Fed and all the high important rankings of the entire US American or the American system. Go have a try at the job, and then maybe come back with a better report card than all your predecessors. That's the first point. The second point is on the idea of working with imperfect information, and that exactly is investing, especially for people that are actively stock picking. You are essentially trying to bet something, to have a view of the future and allocate your capital accordingly. So most of the information that you are working with is insufficient in nature. Who knows whether Alphabet will continue outperforming? Will they continue dominating the search market? Who knows whether Microsoft Bing with ChatGPT is gonna take over Google's search market share? Nobody knows. Now Amazon can be the king of e-commerce in the international world. AWS can be the leading cloud provider. But who is to say that they can continue executing and continue remaining its lead? All of us are working with imperfect information, and we're just allocating capital and readjusting accordingly. So being comfortable with uncertainty is a hallmark of a good investor. So on the third point, where Buffett essentially talks about no point blaming the environment, no point second guessing the environment or the conditions of the economy, and in the very long run, he still prefer to own stakes of businesses or equities over the bond market. So my takeaway of his point is really this idea of the locus of control. So as an investor, you don't have the ability to control whether the economy is going to go through a recession, whether interest rate is going to be at 2%, 4% or 8%. But you do have control over your capital, which company you're going to back. So rather than focusing a lot of your attention around, what's going to happen to the yield curve, what's going to happen to recession, etc., spend more time, look into the companies you have in your portfolio and allocate your capital accordingly. And look at how the management team have been executing, look at how the company have been improving their margins, improving their revenue, whether they are fending off competition effectively or not. Those are the things that you can control. And if you think the business is not very good, don't allocate your capital to them. So in theory, it sounds simple, but execution-wise, far from easy. So moving on to the third video extract.
Some of the banks that you've sold include USB, Wells Fargo, Goldman Sachs, JP Morgan, PNC. Should we think that they're banks that aren't well run because you've sold them? Or?
No,
okay.
no. But I do think, I did think that banking could get in a lot of trouble just because of the kind of things that they did, and that I didn't like the banking business as well as I did before.
Why'd you keep Bank of America?
But I would love to have owned a bank. If Berkshire could have owned 100% of a bank, we'd love to own it. Well, we can't do it under the bank holding company.
Would you like to be a bank holding company?
Well, that means we can't do all the other things we do. So we got taken out of that in 1970. We had just bought a bank in 1969, and we had to get rid of it in 10 years. And there's, I don't argue against regulation of banks, believe me. But that particular option has been taken away from Berkshire, and I think it's probably a good idea to taking it away from corporate managements generally.
Why'd you keep Bank of America?
Pardon me?
Why did you keep Bank of America?
Well, they invited, I invited myself in many years earlier, and they made a very decent deal for us, and I like Brian Moynihan enormously.
Long story short, Buffett essentially changed his mind on the entire banking industry. So he did continue going on saying that he got a pretty sweet deal for Bank of America. So that's why I continue holding on to the position. But I think long story short, this is essentially another hallmark of a good investor, where he's okay with changing his mind. He got in, he thought that something is good, like the economics of the business is good, but thereafter changed his mind because there might be some issues going on an industry-wide level. And it does seem like specifically for the banking sector, it seems like he changed his view on the banking industry rather than stock picking or saying that this bank is not good or that bank is not good. But long story short, I hope you guys gain some further insights from the goal of investing. And if you guys have any more discussion points or any more lessons that you have learned from the interview, do feel free to leave in the comment section down below as well. With that, see you in the next video. More importantly, I will see you on the moon. Goodbye.